Hello and welcome to another platform tutorial. This is a Thinkorswim platform tutorial primarily focused on using the Analyze tab and the risk profiles built inside the platform. This is an unscripted tutorial, so I'm just kind of got to go through all the features and why we want to get really comfortable using the Analyze tab, what it is you can use it for, and then how to move into live positions after you're finished analyzing those positions. So to minimize distractions, I'm just going to move my watch list and get that out of the way. And for the first part of this tutorial, I'm going to be using this particular stock, which, based on today, Zynga is actually dropping into an area where we would be an interested buyer of the stock. And you can see we already have this set up. This is not the important part of the tutorial, but before we jump right in and start doing any sort of trading, we always want to analyze our risk and our reward. Now, many will look at this and say, okay, if I enter at 842 and I have a stop at 826 with targets, higher, then you could quickly analyze how much you stand to make or lose just by grabbing your calculator and, typing in, the difference between 842 and 826. Well, that's your risk. The difference between 910 and 842, that's your reward, the target one. And you could certainly grab the calculator and do that math, but let me show you how and why I like the Analyze tab that much better for this process. So the Analyze tab is the third tab from the left. So if I click on the Analyze tab, you'll see sub-tabs: add simulated trades, risk profile, probability analysis, economic data, think back, fundamentals, and earnings. Now, this particular tutorial is going to be focused on using the add simulated trades and risk profile tabs. But if you wanted to explore more of this probability analysis, you certainly could. We could talk about that in some of the trading rooms if you have questions. Economic data calendar, think back, which lets you go back in time and test out different strategies from pre-recorded options data, stock data. It takes end of day pricing and says, if you were to go back on this day, at the end of the day, this is how much this market was trading for. Here's how much all the options were trading for. And you could sort of backtest some of your ideas using think back. Fundamentals will, as it explains, will focus on the fundamentals and, of that particular market or of that particular company. And then an earnings, schedule, I guess is what it would for this particular stock. Showing what estimates were, what Wall Street's estimates were, and then showing what the actual earnings results were. So, but I primarily use the add simulated trades and risk profile every single day that I'm in my trading platform. I find myself using these two tabs. Now the risk profile is going to be primarily one that I use for my option trades just to visually look at the risk curve. But it all starts with adding a simulated trade. So the Analyze tab, add simulated trades, gives us several things. Number one, at the very top, you have the stock, or if you don't have a stock listed, you type one in. Mine is linked to my charts. That's why Zynga is already over here. It'll also give you the underlying quote, meaning the last price of the stock, the change for the day, the current bid versus ask, the size of the bid versus ask, the volume for the day, the open, high, and low. And from here, you can look down below and you can see the trade grid, which basically gives you level 2 market depth, which I don't really use on this page, and then the option chain, which I use all the time. Okay, this is going to be the tab that's always open for me. So I'll drop that down and you can see all the option expiration months, and then you can drop down each one of those and see all the varying strike prices within the option chain. Now, you'll probably say, well, I can get all of that in the trade tab. You can get the underlying data. If I had this linked, you get Zynga, you'd have all the same information from the underlying, the trade grid, and the option chain, option stats, time and sales, product depth. You have all the same stuff. But what you're missing down here in the trade tab is the ability to add a simulated position and then throw all kinds of what ifs at it. What if the stock price were to go up or down? What if volatility were to change or time were to go by and this is an option position? How would my net P&L be affected by that? And so with the Analyze tab, we can simulate all kinds of what ifs. That way we have a great baseline for, well, if this happens, then I know I'm going to make her lose this much. Well, and if that happens, I know I'm going to make her lose that much. And being prepared ahead of time is always better than just kind of waiting to see what happens with your P&L. So I really like this tab for that. So I always start out every trade in the Analyze tab. Now, if I were looking to just come over here and buy the stock at 842, you could analyze that. Again, you could get your risk, you could get your calculator out if you want. But what I like to do is I like to come over here and under the underlying tab, if you click on the bid, it'll actually set up a 100 share sell order down below as a simulated trade. If I click on the ask above, it'll set up a buy order or a buy simulated trade for 100 shares at the current ask price. So what if I wanted to, analyze this position with a 842 entry, 826 risk? Well, I would come back to the Analyze tab and I would use these price slices. These are critical because what the price slices do is it takes our trade price, which would be our theoretical trade price, 865, or you could type in whatever trade price you want down here. So technically our entry price isn't going to be until 842. So if I highlight this and put 842, and then I come over here to one of these price slices and I type in 842, what you'll see is if my entry price and my price slices match, I can look over here and I can see all the way to the right that my P&L would be 0 if I bought the stock for 842 and the stock is still at 842. And that's an accurate P&L. Now, what about if prices go down and hit our stop loss at 826? Well, I'm going to come down here in this price slice. I'm going to select that area and I'm just going to type in 826. And on 100 shares, this tells me I'm going to lose 16 bucks. Now, your calculator would tell you the same thing, but this allows you to actually see it based upon you just simply typing in your target of 910. So I can go up here and say, what if the price makes it to 910? Well, it says I'd make about 68 bucks. So now you can get a better sense of what is my risk and my reward without having to go back to your calculator. The other thing about a regular calculator that you would just hold in your hand or on your phone is once you do the calculation and you clear it, that information is gone. However, if you keep the simulated trade down at the bottom and you keep these price slices in place and you don't change them, and if you come over here to the far right-hand side and if you reset them, everything resets for this stock. But as long as you don't reset it, as long as you don't change this information, as long as you don't keep this, as long as you keep this stock down here, then it will actually keep your P&L. It'll keep your risk-reward profile saved. So even if I go to an entirely different stock, Apple, for instance, right? And let's say that these price slices were reset, right? And those are the defaults. The middle slice is always the last price. The upper is always 10% higher than the current price, and then the lower is 10% lower than the current price. And this is referring to Apple as a stock being 10% higher or lower than the current price. Now I go back to Zynga, and you can see that my price slices are still locked in. So no matter when I come back and look at this, whether I'm already in the trade or I'm still waiting to get in the trade, these price slices will maintain themselves. This way I can always have a quick reference of what is my actual risk, what is my actual reward potential. And you might say, well, I've got 3 targets, but I've only got 3 slices, which is my stop, my entry, and target. I need 2 more slices. How do I do that? Well, if I come over here to the plus sign, I can add 2 more. Now notice it added them down below, right? You'll notice that when you add more, or if you want to delete one, there's a little menu all the way to the right, or you could right click anywhere on that line, right click, delete slice. It'll take it away. Or you can come all the way over here to the right, left click, it'll give you the same menu. But if I want to add it, it's going to add a new one down below. So here's what I'll do. I'll go ahead and add 979 and 1047 as targets. So 949 and 1047. Did I get those right? Oh, 979. I'm sorry, 979. Okay, so now it looks like, oh, they're all out of order. So now I'm going to lose 16, make 68, make 137, make 205, but they're all out of order. Man, wouldn't it be nice if they would all stack in order, especially in the order that I'm looking for the price to go, which is up once it hits this fair price value demand area. So what you do is when you're looking at the slices that are all out of order, not by price, you can come over here to that menu on the far right again, and you could reorder the slices by price. And what it'll do is it'll put the lowest price at the bottom, it'll put the highest price at the top, and now you've got your entry, which is second from the bottom, one stop loss, 3 targets, and a quick saved reference of exactly what your risk reward position looks like for this particular trade. Love this for stocks. I love this if you're trading futures, right? Let's say you want to buy the ES, and that you're not trading options on the ES. Let's say you just want to buy the ES, which is the S&P futures contract. You come over here to the active contract, click on the ask, and that sets up a buy order, and then put your targets in here, your stops in here. And what this also lets you do, I'm going to go back to Zynga for a second to show you the power of this. What this also lets you do is it also lets you see what your net delta position is, what your net gamma, your theta, and your vega, which gamma, theta, and vega are only options characteristics. Those are not stock or futures or Forex characteristics. These are just, that's why they all say 0. But when you buy 100 shares of stock, or you're short 100 shares of stock, doesn't matter if you buy it or sell it, you'll be long or short, it changes your overall delta position, which is what's being utilized to calculate your net P&L on the far right. So the delta of a 100 share stock position is 100 deltas, because for each share of stock you own, if that stock goes up or down $1, you're going to make $1. So if you only owned 1 share, you would have 1 delta. If you owned 50 shares, you have 50 deltas. If you own 1,000 shares, you guessed it, you have 1,000 deltas. Okay, and this will automatically, based upon your position size down here, as you change it, would automatically change your P&L expectations based upon the size of the position you're in. So a great way to use this from a position sizing standpoint would be to first load up your 100 shares, right? So load up your 100 shares and say, okay, based on my 100 shares, how much would I risk? How much do I stand to make? And say $16. Man, that's a really low amount. You might say, I am willing to risk up to $100 in this trade. So then you could say, how many shares can I buy without exceeding the $100 risk tolerance? And you could bump it up, your position size. It looks like if we get to 600 shares, I'm right at $100, 96 to be exact. But technically what this allows me to do is now position size appropriately for my own personal risk tolerance. If you were willing to risk, $200, then you could probably trade upwards of $1,200. I don't think you could trade $1,300. You could trade $1,200 or somewhere in between if you wanted to do some odd lots. And get right at $200. But you can really customize this and use this not only to gauge your risk reward, but also what position size is most appropriate. Now, going back to the futures for a second, the one question that we oftentimes get around futures is, if the market moves 1 point, how much do I make or lose? And that's going to be different for the ES, which is the S&P futures. It's going to be different for the Dow. It's going to be different for crude oil. It's going to be different for gold. And it's going to be different for corn, right? So how much money do we make or lose is dependent upon what our position delta is. Delta refers to how much we make or lose based upon that market going up or down $1. And so if we go back to the S&P for a second, you may already know that if the S&P 500 goes up or down by $1 or 1 point, we're going to make or lose $50. That's because each tick, which is a 25-cent movement, so 25 cents is 1 tick in the S&P, is worth $12.50 per tick. How do I know that? How do I find that out? Well, if I go back to the charts and I look at big buttons, I'm sorry, not big buttons, dashboard off to the right. Dashboard, which is a menu off to the right, it brings up these big buttons down at the bottom. But this actually tells you that each tick is worth a quarter. 1 quarter equals 1 tick, and it's worth $12.50 profit or loss if the S&P moves 1 quarter. Now, if the S&P moves 4 quarters, that's a whole dollar. Therefore, $12.50 times 4 is $50. That's how we come to the conclusion that we make or lose $50 per point. Now, to take that one step further, if you look at the Analyze tab, the delta is going to be equal to how much money you make or lose as that particular market, in this case the S&P, moves $1 up or down. And so what this tells us is we are controlling 50 shares of the S&P 500 with one contract, which means if you're controlling 50 shares, you're going to make or lose $50 on a $1 move, okay? And so this actually very quickly helps us identify how much money we're going to make or lose if that market moves $1, because it naturally translates into a delta. So if you were to look at gold, for instance, gold trades in 100 ounces per contract. So if I click on the ask, you can see my delta is 100, which means if gold moves up or down $1, we make or lose $100. Crude oil, on the other hand, is controlling 1,000 barrels of the stock of crude oil. So if I come over here on the bid and I'm shorting oil, if I short oil, I want to hit the bid. If I want to be long oil, I hit the ask. So if I want to be short, notice it sets up a sell one crude oil futures contract, 45.68, and our delta is a negative number. Because if the crude oil market were to move up in price, this would be a negative for our short position. And we would lose $1,000 per $1 move in crude oil, which is consistent with controlling 1,000 barrels of oil. If you were to look at corn, ZC, corn, if you were to go long corn at the ask, then you're going to make or lose $50 per point. And so this is a really great way if you're unsure, like if you're like, man, I'm really interested in trading silver. I've never traded silver before, you might say. I type in the symbol for silver, but I don't know how much money each point is worth in silver. So you could look at the chart, of course, and you could come back to the dashboard. And you can say, well, it looks like silver moves in half a penny increments. And for every half a penny that silver moves, I make or lose $25. Man, that is really sensitive. That's $50 a penny. $50 a penny, which means that if silver moves a whole dollar, if each penny costs me or makes me $50, that means the whole dollar is going to cost me $5,000. And if you're like, man, I don't want to have to do that math, then here's an easy way to do it. Come to the Analyze tab, load up silver, come to the active contract, click on the ask, and it'll tell you your delta is 5,000, which means if silver moves $1, you're going to make or lose $5,000, right? Because that's what your net delta is. So I really like this tab even for futures traders because it gives you a really great sense of A, what your exposure is, and B, when you type in your price slices in which you're looking to enter and exit for stop loss and target, customize those price slices, it locks those in, and based upon your silver entry price would give you your net P&L for that trade. And so again, it stores it, it keeps it unless you reset it, which I absolutely love when I go back and continue to reevaluate positions that I either want to get in, that I'm still in, and I'm considering getting out. So I really like it for trading anything related to stocks, Forex, futures, you name it. Now, when it comes to option trading, let's go back to Zynga for a second. When it comes to option trading, this is an absolute must, right? I have to use this because what this is going to do for us is it's going to, and I'll just delete this stock position here. So just to delete a stock position, come over here to the far right and click the X, and that deletes the stock. It deletes all the data inside your price slices because you're no longer simulating any particular trade. Now, if we were already in a trade on Zynga, as a for instance, and you added, like, let's see here, we've got Facebook, I think. Yeah, so we've got Facebook. Facebook is a position, just a one contract position right now, but you can see that by showing all, right? By showing all, we're seeing both our active positions and simulated positions. And if you want, and your price slices are including all your active positions and your simulated positions. So there's a couple different ways if you want to leave your current positions out of the, risk reward calculating, leave the current positions out. You could do one of two things. Number one, when you have all the markets in plain view here like this under your simulated trades, again, we're still under the Analyze tab. You could uncheck the markets that you don't want the price slices to analyze. You could uncheck them, right? You could say, only show me my active positions, or uncheck all your active positions and only show my simulated positions. So that's one way to do it. Another way to do it is to just use this drop-down menu that says show all by default, or hide all my current positions, or hide my simulations. And so that way, when you're analyzing your price slices and you're studying the risk profile, this is an Iron Condor risk profile. I'm not going to get into risk profiles and how to read, these in this series. We have a whole another series in our options, foundations on this subject. But it shows you the actual visual representation of your risk reward real time, which is the purple line, and the black line in the background that has this diagonal hard right edge. This is your expiration risk graph. So these options expire on the 15th of January, 2021. And so you can analyze your risk profile on all your option trades in here, which makes it really helpful. But what is most helpful about this is, let's go back to Zynga. Set up a new trade. So add simulated trades. And let's say because, let's see, volatility is extremely low right now in Zynga. So I might say, okay, I'm just going to buy a call option. I would choose my expiration. So I come back to the Analyze tab. I would choose my expiration. And I'm going to choose at least 90 days because those are rules that we follow. So I'll expand to March 19s. And I'm going to come down and I'm going to look at buying a at-the-money option. So if the price of the stock gets to $8.42, we're going to go ahead and buy an $8 option. It has 33 contracts open interest, and we'll pay about $1.20. The bid is $1.15, so the spread is only 5 cents wide. And the reason it's so narrow is because there's a lot of interest around these options. We'll have 0.66 delta per share, but watch what happens when I click on the ask. And why am I clicking on the ask? Well, because when it's time and the stock gets to $8.42, I know that I want to buy the $8 call option, and since I want to buy it, I'm going to click on the ask. If I were interested in selling any one of these options, then I would click on the bid for that particular strike price. Again, calls are on the left, puts are on the right, so you would navigate to which option you wanted to buy or sell. So by clicking on the ask of the option that I want to buy, which is the $8 strike, then it drops the $8 call option down below. Now, this is just one contract, okay? If yours says 10 contracts when you do that, I would suggest changing the default to 1, because we always want to analyze just one contract first and then go higher. If we can position size even larger, just go higher from there. So if you're unfamiliar with how to change the default from 10 to 1, come up here in the far right to your setup tab, very far right top, hit setup, application settings. And if you come down to order defaults, which is the third tab over, which is the center tab, click on options, and your default quantity of orders will say 10. You want to change it to 1 and apply settings. Now, anytime you establish a new option position, or at least one that you're simulating, it'll default to 1 contract. Otherwise, you're going to have to start at 10 every time and then drop it to 1 every time, which is, kind of not efficient. So here we have Zynga. We still have our price slices all mapped out, stop entry targets, all that's still mapped out. But instead of buying the stock outright, we're going to analyze what would it look like if I bought bought an option instead. So what we can see here is at our entry price of $8.42, if we were to pay $1.20, our P&L says we would lose $15.43. Well, how's that possible? Because if I'm just getting in at $8.42, how am I already down $15.43? That makes no sense. And you're right, it doesn't make any sense. Because if you think about this P&L should be really close to zero. Really close, if not exactly zero, at your entry price. So what this is telling us is that if we buy these $8 calls at today's price, which is $1.20, then we would be paying $15 too much for this option. So if we're paying $15 too much, then our risk calculation is going to be off by 15. Our reward calculations are going to be off by 15. Everything is off by 15 until we zero out this P&L. How do we zero out the P&L? We come down here and we reduce by 15 cents, roughly, until that gets really close to zero, about as close as you can get to zero. Okay, so $1.05. And now we can anticipate not paying $1.20 for this option, right? Because think about this, when the stock price drops a little further, then the option is actually going to be, declining in value as well. So today's prices at $1.20 are not realistic for what we're going to pay when the stock is actually at our entry price. So we can say, okay, I'm anticipating paying around $1.05 for these options based upon my entry price of $8.42 and my P&L being 0 at my entry. Now that I've zeroed that out and I've got my, anticipated entry price on the option, now this is a better representation of exactly how much we stand to lose. I take that back. This is a better representation of theoretically what we stand to lose. Barring any big gaps or massive changes in volatility or long period of time going by. This is theoretically what we would lose if we were stopped out today. It's not a guarantee. Don't hold the platform to the letter, to the number that, hey, you said I was going to lose 10.27 and I lost $12. Well, this is theoretical P&L based upon your delta, your gamma, your theta, and your vega. Now, we're not even considering theta because we're not considering time going by. This is today's date. And we're not even considering changes in volatility yet. This is just based on delta and gamma. So these numbers not being static numbers for the entire life of the trade, these are dynamic. Option Greeks are all dynamic. Then this P&L is going to change over time. So don't hold it to the number here. It's not to the penny perfect. No platform can do that for you. So this is theoretically what you stand to lose. And you say, okay, well, I can handle that. So if I can handle $100 worth of risk, then you could go up from here and say, just keep clicking the up contract size until this profile says my P&L will be about $100, right? And 10 contracts takes me a little bit over. So I never want to be over my dollar amount. I always want to be a little bit under and leave a little extra room for slippage or commissions or both, actually. So now that we stand to lose about $92 today, if we get stopped out at our 826 stop loss, you can see that we stand to make 415, 902, and 1400 on this particular long call position. You might say, well, okay, well, that's awesome. You can see what your delta is. You can see what your gamma, meaning if Zynga is moving in price, that's going to impact your options premium based upon whatever the option delta is. But your option delta is going to evolve based upon whatever your gamma is. So then as we look over to the next column, theta, this is going to be a critical one for only option traders, right? So theta and vega are for option traders. Theta is our time decay. If you want more lessons on time decay, check out the Option Greeks in Options Foundations. We talk all about it in there. But theta tells us how much money we stand to make or lose, depending upon if we're long or short an option, every day as we get closer to its expiration date. So on a 9-contract position, we are losing $3.50 a day, roughly $3.50 a day, just in time going by. So if you're in this trade for 5 days, it's going to cost you at least $15, $16, $17 in time decay. So you're going to have to make that $15 to $17 up somewhere else. Ideally, the stock price is moving in your favor and you're making it on delta really easy. But we are going to lose about $3.50 a day in theta. Now, on one contract, you'll see it's only 39 cents, roughly. So when you bump your contract size up, it will actually display what your total theta would be, or your total delta, your total gamma, your total vega on a per contract or per position size basis. So if this were a 20 contract position, you can see what your open P&L, your net P&L would be, and all of your option Greeks associated with this position. Okay, so I like that it does all this math for us, because doing this by hand on a calculator is not only inefficient from a time perspective, it's going to be difficult to keep track of this information if you're using just a calculator on your desk throughout the life of the trade. Whereas, like I said, if you keep this information plugged in and you don't change the price slices over here, and you keep your positions down here, you can analyze all of your Greeks, all of your P&L, everything about this trade on an ongoing daily, weekly, monthly basis. For as long as you want to analyze it, everything stays as it was when you first built it. So it's a really, really helpful tool for continuing to monitor any current positions plus future positions. So you might say, okay, well, theta is going to negatively affect us $3.50 a day. So that being said, I can take this date down here and I can go into the calendar and I can say, well, what happens if I'm in this trade for today's the 9th of December. So what happens if I'm in this trade till the 31st of December, till basically the end of the year? How's that going to impact my P&L? Well, it's going to take your theta, it's going to subtract that daily theta every day until you get to the 31st or whatever date you chose here, and it's going to add that theta loss to your delta loss, and you can see it actually increased the risk to $175. Now, we also decreased our reward potential because theta is hurting every aspect of this trade. So the longer it takes for this trade to develop, the more money we lose or the less money we make. Now, Vega, which is our volatility sensitivity, you might say, okay, if the stock price starts to go up and volatility is really low, might I be able to anticipate a rise in volatility as demand for these options may end up picking up? And you might be able to, squeeze a few volatility points out of it. You can see when prices rose, last time prices started to rise, volatility dropped sharply because of earnings, but it just kind of stayed still. It didn't really do a whole lot. We got a little bump in volatility right here. I don't know if you guys can see that. Let me expand this a little bit, but we got a little bump in volatility here, and that bump went from basically 44% up to 60%. So that's a 14 or 16 point move in volatility, and now it started to decline a little bit. But if you're looking at this and you say, okay, well, if the price of the stock goes up and volatility were to go up, come back to the Analyze tab, how would that impact me? And we can see that because we have positive numbers here, not negative numbers. Like theta is always a negative for long option positions. But for Vega has a positive sensitivity to rising volatility. So if volatility were to rise even 10 points, right? Not even the full 16 that it did last week, but if it were to rise 10 points, we know that we're going to make $13 roughly, anywhere between $10 and $13 per point, per volatility point. So how do I adjust my P&L to anticipate that? In other words of saying that is, what if? What if we're in this trade till December 31st? What if, I'm going to come down here and I'm going to click on this big cog on the far bottom right, big cog. I'm going to say, what if volatility, here's your vol adjustment, rises 10 points? If you wanted to see what it would do if it dropped 10 points, just put a minus sign in front of it and that'll do it. But if volatility rose 10 points, hit enter on your keyboard, notice that a rise in volatility helps offset our time decay risk. If we don't get a rise in volatility, then we've got delta working against us at our stop loss, theta working against us every day without Vega working for us, right? But if we get a volatility increase by 10 points, which is not quite the 16 that we saw last time, but just being a little conservative here. Heck, even if it moved, 5 points, right? 5 points is nice. But here's what happens. It improves our position. We make a little more money. We don't make, money at our stop loss. We would still lose on delta, but even the negative theta aspects are somewhat, made up for. We can actually make money on volatility while losing on theta. So if volatility were to rise 15 points, which is what it did last week, which is what it did last time it rallied, then watch this. Delta says we're going to lose money if the stock price drops, right? But theta also says we're going to lose money as days go by, which is why we already pushed this out to December 31st, because it's a 3-week maybe swing trade. But then volatility benefiting us, if volatility rises 15 points, notice that even if we get stopped out below 826, even though it took 3 weeks to get stopped out, if volatility rises enough, that pays for all the theta loss, all the delta loss, and we actually still make money even though we were stopped out and proven wrong. Now, this may not be, naturally intuitive if you're newer to options. If you've been trading options for quite some time, this might be naturally intuitive that this would happen. Oh yeah, I could make a bunch of money on Vega, even though I'm losing money on Theta and losing on Delta. But what this analyzer does, and this is the best one that I found so far, not that I've probably tried every single one in the world, but this one is designed to make this really, really easy. But what this tells us is, if I can anticipate Delta and Theta hurting me, and I can anticipate a rise in Vega, this tells me how much of a rise in volatility I need to break even at my stop loss. And really, all I need is about a 13-point rise in volatility to break even at my stop loss. And you might look at this and say, well, is a 13-point rise in volatility realistic? Well, right now we're at 51. So if we rise to 65, which is basically here, 65%, is that a realistic rise in volatility? I think the answer is yes, because we saw that last time prices rose and broke out into this newly formed uptrend is what it's looking like. And so what this analyze, what all these price slices and analyze allow us to do is, before you ever even get into the trade, it's critical that we understand our risk and reward associated, especially when you're talking about with options, to the price of the stock moving, time going by, and volatility changing. With futures, forex, and stocks, your biggest concern is what happens if the stock price changes, or what happens if the instrument's value changes. How does this help me gauge my overall P&L? But without this tool, it would be such a tedious and inefficient task to try and figure out how volatility, theta, and delta were going to affect your options positions, and even remotely be, near what this computer-driven pricing model, because this has basically the Black-Scholes pricing model, or the binomial or Brooks and Stenslin pricing model, whichever one you're using down here. They're all similar, but I just leave it to the default, the Brooks and Stenslin. It's using the pricing model that is used to price the theoretical value of options and all the Greeks associated with the options. It's using that to calculate your net P&L since you've been in the trade, so that's P&L at the open, or since just for the day only. So it's a really critical tool to have. So I'm going to reset all my volatility back to 0, right? So to do that, I'm just going to take this 1310, type in 0. I'm going to take the date. I'm going to take it back to today's date. Okay, so now we're back to today's date. No change in volatility, just our stop losses and targets if we're in this long $8 call option. Now, the other tab that I want to show you guys, which is a sub-tab to the Analyze, is this Risk Profile tab. The Risk Profile tab will show you a visual representation of your position risk, and the Risk Profile is by default set up to do one real-time curve, so that's the purple line on my platform because I'm using the light theme. They might be different colors depending upon if you've modified or what color theme you're using for Thinkorswim. And then the black line is going to be your expiration risk graph. So the expiration risk graph is all the way out to March. And then the purple line is your real-time risk profile. It shows you what's known as your delta curve. So this shows you if the stock price were to go up or down $1, how much you'd lose or make. Now, again, I'm not diving deep into risk graphs here. We did that in another session. But what's nice is this will show you visually. And so if I hold my cursor over this risk profile and I hold my cursor over my 826 vertical dashed line, that is my 826 line that I typed in here. Notice I can grab this and I can move it around, right? So if I want to move my stop loss down to $8, I could do that. But ultimately, it's not going to change this down here. It's not going to change that because I have that locked in place. Now, if I don't have it locked in place, if I just simply unlock it, now I can move it. I can move it wherever I want, and it changes this data. But if I want to keep my stop at 826, I just come down here and type in 8.26, right? And again, over here on the right tells us our net P&L, but you can also see in the bottom left-hand corner of the risk graph window, depending upon where I hold my cursor, which is a little Mickey Mouse glove, is what it looks like. If I hold my Mickey Mouse glove over 826, you can see in the bottom left-hand corner, right here, that I have about $92.95 worth of risk. If I hold this position all the way out to 3/20/21, which you can also see right down here is my expiration date of this contract. I hold the cursor over and it tells me I would lose about $711.90. So about $712. Why would I lose $712? Well, because the stock moved against us from 842 down to 826. So that's a loss in delta. Plus, it's all the time decay that's going to go by all the way to expiration, which is in March of 2021. So holding your cursor at different spots on this risk profile, you can actually see what your P&L would look like real time. So you can say, what if my target is here? What if my target's 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 way up here at $11.31? What's my profit target? You know, what's my profit telling me I'm going to make? Around $2,011, right? And so it's a really great way to not just by the numbers figure out what your position size should be, what your risk is associated with option Greeks or movement in the underlying. This also helps us, what was my third target? 1047. This also helps us to really narrow down exactly what our option position risk looks like so that we can really fine tune everything about our trades before we ever get in. You know, one of the biggest, things that many new traders especially are really kind of cursed with, I guess, is until you get, enough time in front of the screen, until you get your hours in, there's going to be so many unknowables for somebody who's new, and especially the option trader. So many unknowables. How am I supposed to know how theta and vega and delta and rho, if you want to look at gamma, if you want to look at volatility, you could, there's so many factors that exist, especially within trading options, that this tool makes it easy for somebody who's even brand new to really start to understand the mechanics of options. So not just from a trading standpoint is this Analyze tab between the Add Simulated Trades and Risk Profile tab. These two tabs are really great for what I just showed you as far as like really establishing the right position size and understanding your risk reward. But this is one of my key tools that I use to teach students on how to start to understand the mechanics of options and the evolution of your position, right? So if I go back to the risk profile and you say, okay, well, every day that passes, let's say that I'm in this trade to the 31st, the end of the month, watch what happens to this purple line. It's going to evolve in, I'm going to click it in 3, 2, 1, go. Notice the purple line actually dropped down a little bit, right? Let's go back. I'm going to click the calendar and go to today, and it's going to go back up, right? It went back up a little bit. Why did my purple line drop when I changed the date, right, to the 31st? Because if I go 3 weeks into the future, theta is costing us $3.50 a day. Visually, what that means is the purple line is going to drop a little bit, right? Because theta is costing us more money. If I day step this one at a time, and I just hit this plus sign here, one day at a time, I'm just clicking away. Notice that purple line is over time, it's evolving, and it's going to evolve into that black line, which is our expiration risk profile. And notice the whole time, our delta, our gamma, our theta, our vega, and our P&L is evolving based upon how much time it takes for us to get in or out of this trade, okay? Same thing would happen if you were to make vol adjustments. If we were to make 13 points in volatility changing, then that's going to send this purple line higher, right? So 13-point rise, you can see it jumped higher. Why did it jump higher? Because we are positively impacted on a rise in volatility. But if I go to the calendar and I go out to the 31st, it's going to drop the purple line lower again because theta is a negative. And so this tool is really great, yes, analysis tool for your real trades, but this is one of the best things that I could ask you to do if you really want to understand the mechanics of options and you want to understand the evolution of an option trade and the evolution of your option Greeks associated to your option trades. Then this tool allows you to throw any what if at it and say, what if, more parameters? What if interest rates change? What if, here's your interest rate sensitivity? What if volatility changes? What if the stock price? There's so many things you could throw at it. And what's best about this is you can You can type a whole bunch of stuff in, and you can mess around with stuff and say, you know what, let's just reset all the parameters. You can't break it, but it does give you an opportunity to learn more about how options evolve. Now, as far as what if your risk graph looks like this and it's all the way to the side, it's like, I don't even know what that looks like. Really what you have to do is you have to drag. So by clicking and dragging inside the window, you can actually drag your point of view a little bit to the right or the left. And if you still say, I want to zoom out a little bit, how do I zoom out? Well, along the lower horizontal price line, left click and hold on your mouse, and if you squeeze to the left, you're zooming out, right? So you can see more of the risk profile. If you want to left click and move to the right, all you're doing is zooming in. And there's not too many times where I want to zoom in because I can't make really anything out. But many times I am zooming out, and then I'll center it. This way I can get a good look at big picture. What does this position look like from a risk profile? Okay. Now, a lot of this stuff that you can do down here at the bottom, you can do across the top as well. Like I have it set to exclude commissions because commissions are so doggone cheap. But if you wanted to include your commission structure, it would include your commissions in your analysis. If you wanted to look at, like we day stepped down here, you could do the same up here. You could vol step up here as well. What I like about down here and using the tools down below versus using these tools above is the tools above only let you either change the day or vol down here, which is volatility. But down here, it lets you change both at the same time, and it will collectively calculate your risk reward. Whereas if you're doing it up here, I don't think it allows you to analyze both a change in volatility and a change in your date, whereas down below it does. So I prefer to use all the tools down below. I don't use personally any of the tools above. Okay. Now, like I said, probability analysis, economic data, think back, fundamentals, earnings. These we could discuss a little later. These, I don't think I've ever really used much of any of these. Every now and then I'll use the fundamentals if I don't know what a stock does, like Zynga. If I didn't know what Zynga does, I could go over to fundamentals and say, well, it's in the communication sector. It's a provider of social game services. Okay, so cool. Now I know what sector Zynga is in. It's rare, but sometimes I'll come down and look at some of the fundamental valuations. But I'm only doing that for longer term positions, not for trading positions. But this little tutorial should get you a really nice head start on how to use this section of the platform to start analyzing your positions. If you're used to staying on the trade tab a lot, then what I would suggest is start on the analyze tab. Because even if you go to the trade tab first, you say, yeah, well, I can do that from the trade tab. I can set my, 115 or 105, but you can't analyze your risk and your reward. And you might say, sure, I can just right click anywhere on the order and analyze that trade. Okay, yes, of course, you can do that. But why start in the trade tab only to send it to the analyze tab? And then from the Analyze tab, send it back to the Trade tab. It makes no sense to me to start in the Trade tab. It makes more sense to me to start in the Analyze tab. So once I've analyzed everything that I want, and if you want to look at different columns under any of your option chains, you can change those up here. Mine are set to Delta and Open Interest. But if you wanted to look at something different, you could look at anything different here. You could save your layouts, right? Save or customize your layouts and say, show me Delta, Open Interest, and volume. If you wanted to, show volume, you could do that and just add volume. Just add that item, and then it would populate volume in your option chain if you wanted as well. But once you're ready to actually send this order and actually make a real order out of it, easiest way to do it is on your simulated trade down below, right click. If you wanted to confirm and send it without placing any stops or targets, you can confirm and send it from here, but then you'll have no stops or targets. It's just the one trade. What I prefer to do is create a duplicate order. Right now, this is just a simulated trade. It's not even an order. So to create a duplicate order now takes you over to the order bar, in which you could, use a series of, first trigger sequence, first triggers order, cancels order, and actually start to stack up, closing orders in addition to your entry orders. And again, I have a whole series of tutorials on order entry, so I'm not going to do that here. But that is how you would actually get your analyzed trades over to make them real orders that you want to send to the actual market. Now, let's see. I think that's a good majority of the functionality that you're going to want to be using on a daily and a weekly basis. The last thing that's just a little trick that I found to be really helpful, if you're trading, spread trades or trades, option trades specifically that have multiple legs attached to it, multiple legs, more than one option. Like for instance, you might want to buy the $8 call, but you might also want to sell the $10 call against it and create a bull call spread. Well, if I'm in the Analyze tab under Add Simulated Trades and I just click on the bid on the 10s, notice it does set up a 10 call where you're selling 9 contracts. Okay, so make them consistent. I mean, really, we'd be starting with 1. Right, 1 contract apiece. Okay. You can see you're going to pay $1.05 and receive 39 cents. Well, I don't find much value in analyzing them and entering them as 2 single orders, right? There's not much value in fact, you don't want to enter these trades as real market trades. You don't want to send them to the market as 2 single orders because there are specific margin requirements for each of these trades. And so if you sell a $10 call naked and you don't buy the $8 call that's attached to that $10 call, they're going to hold up a separate margin requirement for selling the $10 call naked versus the $105 they would tie up to buy the $8 call. So what you do is, I'm going to delete the $10 short call, and I'm going to hold the control key down on my keyboard, right? So on my keyboard on my computer, hold the control key down. Now if I click on the bid, it adds the $10 call that we want to sell to the $8 call that we want to buy, and it combines them into one vertical spread trade. Now, you're still going to analyze this position, right? I'm going to unlock this and make sure I zero out my P&L here. So that gets us down to about 0 P&L. So I should pay around 70 to 75 cents for this spread. But now it's going to tell us what the debit is for the net of this spread. So if we're buying the 8s for $1.05 and receiving 30 something cents for selling the $10 calls, then our net debit is around 71 bucks. Our net delta is now 33. Our net gamma, our net theta, and our net vega, and our net P&L are now displayed, because this is considering now 1 long 8 call option and 1 short $10 call option as one trade. Now from here, once you're ready to create an actual position out of it, whether it's 1 contract or let's say it's 10, or you can risk $100, so now we can go up to 16 or even 15 contracts if you want to leave a little extra wiggle room for slippage. This tells me we're going to lose 93 bucks if we get stopped out. No change in time, no change in volatility. So 15 contracts, I'm ready to trade it. Right click anywhere on this simulated trade, confirm and send to send it with no stops, or create a duplicate order to then start stacking up your stop losses and your targets. And right clicking and creating the opposite will set up your closing trades below your opening trade. And then of course you want to make sure you have your advanced order staged to accept this order the way that you want it to be. But again, that's a whole other subject. That's order entry. This would be entry, stop, and target, right? That's why you have a first triggers OCO. But again, a majority of your work will be done in the Analyze tab. Very little work will be done in the Trade tab, if any, because you'll notice when I create a duplicate order out of my analyzed trade, all it does is bring up the order bar from the very bottom, right? So that's all it does. It brings up the order bar from the bottom. We're still on the Analyze tab. It just brings up the order bar. And if the order bar goes away because you went to a chart, you're like, let me double check something on the chart, come back to the Analyze tab, or stay on the Chart tab if you want. Come down to the bottom and find this little tab right down here in the bottom left, and that'll bring the order entry bar right back up. Okay. If you need to go back to the Analyze tab to see where your stops and your entries and your targets are, right all in here as you're setting up your order, just do that. You can keep them nice and handy, and you can start to build your trade out as it's suitable for your own personal account. So this is one of the things in the platform that you should get very familiar with. You know that if you've been in our trading rooms, that we use this tab a lot. Great way to analyze risk reward for any type of trade: futures, stocks, forex, options, you name it. Great for risk reward calculating. Great for risk reward ratio. It's great for saving the data about trades that you analyzed. And so it's also great for really learning the mechanics of each instrument that you're learning how to trade, whether it's stocks, futures, options, forex, doesn't matter what it is. So really get familiar with this. This tutorial should hopefully give you a great head start into jumping into your own sessions, giving you more confidence and being less scared about jumping into this tool, because it can be overwhelming if you don't know what all the buttons do.